Good afternoon, everybody. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back again with you today with our weekly wrap-up. Graham, it seems like the market gave it and then take it away last week. What do you have to tell us about that?
Stacy, you hit the nail on the head. That's exactly what it did, right? We sold off the week prior, sold off, rallied the first couple of days of this last week up about almost 6% on the major indices. And then by Friday, we gave the majority of it back, and we still saw the Russell Index up, I think, about 1.5%, and the Nasdaq up almost 1%, the S&P possibly up around the Russell range. But it gave most of it away, right? It's that conviction is just not in the market. We had a strong, actually, unemployment number. And what I mean by that is that we had the unemployment rate go down from 3.7 to 3.5%. And that's actually a negative, not a positive, if we want the Fed to tamper their hawkish approach about raising interest rates. So that really spooked the market, and we saw a sell-off. The 10-year U.S. Treasury yields have risen for 10 straight weeks. So we had a relentless rise in the yields, which is putting pressure maybe on the growth side of the market, because earnings that are in the future can be discounted. Borrowing cost is going up. So we do know the effects of what the Fed is doing is going to cause what they want it to do. Fear, panic, we're seeing in the economic, we're seeing in the markets, right? But we just haven't seen it consistently in the inflation numbers. And that's what we need to see right now. Job openings did come down. And I mentioned this in our lunch and learn. That's kind of interesting. So job openings came down, and that could be a precursor to the unemployment rate going up. But we just got to see it, right? So right now, we're kind of in a wait-and-see pattern. Internationally, it's kind of interesting. We saw the Australian Central Bank, one of the few right here, or maybe the first here, really, I think they actually raised interest rates by 25 basis points instead of 50 or 75, following some of the others in the area. We did still see stubbornly high inflation rates, but we are seeing some consumer weakening, which is why we do feel, and we're not the only one out there, I think you're looking at Europe and then the developed international, probably seeing a weaker or a deeper recession. And it's still a question mark on where we're going to be in the United States. Our personal opinion is maybe a lighter one. We'll just have to see where it goes. But we do need some of these rollover in the inflation numbers, and we need some consistent pattern of that, so the Fed can be less hawkish.
Okay. Well, it just seems like we don't have a picture of what the market's going to do short term. So what do you suggest our investors do?
Well, we don't have a great picture. I mean, right now we're a little bit no man's land. We're in earnings season. Everyone wants to see earnings come down, but then again, you don't want to see them come down a lot. It's kind of one of that little game, because you want to see weakness, right? But then again, you don't want it to be too weak. So we're right in the middle of earnings season. It's probably going to be a bit dramatic. The market is right back to where we were in very oversold territory. So any positive, the Fed stepping up and say maybe they can be less hawkish, maybe some cracks in what's going on with the war in terms of maybe an abatement of some sort, anything like that, any positive, you could really see these indices in the markets rally. But until we get clarity, at least on the inflation front, since that's front and center right here, not to make light of the war by any stretch, I think we just have to acknowledge for the foreseeable future, and it might be very short term, matter of weeks and months, maybe quarters here, we got to expect to be in a little bit of no man's land until we can get some clarity.
Okay. Was there anything specific that our pre-retirees and retirees might need to consider?
Well, again, broken record here. I'll completely admit that. Listen, I want you to be a little extra conservative. I want you to set some extra cash aside, tighten the purse strings a little bit, be a little bit more mindful. I know you are, because inflation hit you on fixed income more than our long-term investors who are younger, or they got many more years until they're going to need these funds. So I think for the pre and post retirees, 2 years and retired, keep a little extra cash on the sidelines. We're saying 1 year of your fixed expenses, shorten the maturities of your bonds, increase the quality of your investments. CDs, interesting. 2-year Treasury yields, interesting. On government debt. These are all things that you can put into place and have what we call laddering, to have money coming due if rates continue to go up. That's protecting you, and you're having cash available to cover your expenses for the next 6 months, 1 year or so, as we kind of move, or this question mark of a recession, so on and so forth, moves through the system, right? For our long-term investors, hey, listen, focus on a great diversified portfolio. There's a lot of awesome things on sale. I know that's a great financial term, right? Awesome. But you got a lot of great high quality companies that are discounted tremendously. Sure, they could go down more. But you know what? You cost average in, you keep your mindset for the future. You're buying here at lows. You're hopefully averaging a lower price. That could set you up for great gains in the future, which we know down the road, listen, the market's going to be higher. We just got to get through this short-term drama right now.
Okay. Well, thank you so much for that. And thank you to our viewers for joining us today. One last reminder about our Retirement Planning Today class. It starts tomorrow. So we have a couple of spots still available. If you or someone you know would be interested in joining us, please have them contact us right away so that we can get them scheduled to join us for the class. And aside from that, we'll look forward to seeing everybody next Monday on our next weekly wrap up. We hope everybody has a great week. We'll see you then. Bye-bye.